Welcome, everyone. Today, my guest is Brian Zitin, the CEO of Reggora, to talk about the appraisal changes announced by Fannie Mae several weeks ago. Brian started Reggora in 2017 as a senior at Boston University after successfully launching a real estate brokerage with his roommate. The Reggora platform looks to streamline and automate the valuation process, and the company now works with some of the biggest lenders in the country. The changes from Fannie Mae mean we have a lot to talk about. But first, here's a word from our sponsor.
Hi, this is Diego Sanchez, COO of HW Media, and I'm joined today by Alex Ilazai, Chief Strategy Officer at United Wholesale Mortgage. Thanks for joining us today, Alex.
Hey, Diego. Thanks for having me. Good to be here.
So diving right in, we might be seeing the first glimmers of a rebound in the housing market. How is this playing out in the broker channel?
It's playing out really well, so we're excited about 2023. We see a lot of optimism in the market, just like we in 2022 and leading into Q4, and we're hitting the ground running really fast in 2023 here in Q1. We're excited about this whole year and what's upcoming. We've launched a lot of new products. We continue to see a lot of optimism in the broker channel overall. And obviously, when we're in a purchase market as we're in right now, that's where brokers really thrive in the more complex transactions with buyers and sellers and agents and a lot more going on. Just brokers are the best place for a consumer to get a loan. So we see a lot of them continue to grow and thrive.
Digging in a little more there, most forecasters are seeing rates in the 5s and the 6s for 2023 and 2024, which means we will be in a purchase market for the foreseeable future. Is this good for the broker channel?
Yeah, it's great for the broker channel. Like I just mentioned, just assume a rate's at 6%, right? We have temporary buy down products, just as an example, where you can buy down that product where the first year you're going to pay 4%, second year you're going to pay 5%, third year and beyond you'll pay the 6%, and by that time hopefully we'll be in a position where you can refi that loan. So really there's just so much opportunity. To me, the way that we think about it, Diego, is like you're dating the rate but you're marrying the house, right? So you want to go out there, if you see the house that you like, you see the property you like, you buy it, right? And you worry about getting that lower rate maybe in a back half of the year or even next year. But again, it's just going to be a short-term thing the way that we think about it. And still, relatively speaking, we're not talking about massive interest rates, right? I mean, the days of the 2s and the 3s that we were experiencing in 2021, that was somewhat of an anomaly. So we expect them to come down a little bit, and all the forecasters and economic indicators are pointing that fashion. But right now, I think we're in a good spot, and brokers are continuing to win. And you can see it in our broker share and everything that we're doing. We're just having an outstanding start to the year.
Yeah, I mean, the broker channel's had a great couple of years of growth. Do you expect that growth to continue in 23?
Yeah, we do. I mean, as you mentioned, in the third quarter, which was the latest quarter, actually fourth quarter, is about 22.5% or so of the market is broker now, which is, I think, at the highest since 2009. So we're continuing to see great trends in the overall growth of the channel, and we expect it to be 33% by 2025-26. Like that's what we're expecting to see the numbers come in at. And a lot of that is being driven by just literally hundreds of retail loan officers that are leaving retail and joining wholesale every single month. So those numbers are continuing to do great. And we're actually seeing, as another example, Diego, at UWM here, we have about 400 to 500 loan officers that come in every single week for Success Track, which is a great opportunity for them to learn, develop, network, and help grow the overall broker channel together. So you're seeing a couple thousand people a month that are coming in, and that was happening in all of last year, right? And all the years, several years before that when we started. But if you think about like the times that we're in, right? Everybody talks about a lot of the negativity, and that's what the usual focus of. But the reality is, people are excited about it. Brokers are excited about it. The market's growing. And at UWM, obviously being 100% wholesale, no otthe company in the mortgage space is better positioned than we are.
I love seeing the confidence and the leaning in that's happening at UWM. Alex, thanks so much for joining us today and sharing your insights.
Great. Thank you. It's good to spend time with you.
Brian, welcome to the podcast.
Thanks for having me, Sarah. I'm excited to talk appraisals.
Oh, I am so excited. Wow, this is such a hot topic, and especially because a couple of weeks ago, obviously, Fannie Mae made headlines with their appraisal announcement, which basically expanded the use of appraisal waivers, now called value acceptance, and added some new options too. Can you walk us through what the changes were?
Yeah, so essentially, things started out obviously with just full appraisals for, most or all transactions. Then over the years, both Fannie, Freddie, they added something called, an appraisal waiver, which was essentially on a certain percentage of transactions, you didn't need to get anything. It would just be, approved. More recently, in the last year or so, they introduced both Fannie Mae and Freddie introduced desktop appraisals, which was an option where essentially, no one had to physically visit the property to gather any data or do an inspection. The appraiser could just do an appraisal at their desktop. And now they've added, I guess, a fourth/fifth option. For Freddie, it's called a PDC. For Fannie, it's called value acceptance plus property data. They're rebranding the appraisal waiver and calling it value acceptance. And so for the value acceptance plus property data, essentially someone goes to the property, does a physical inspection, gathers a bunch of data points, takes a bunch of photos. It has to be in a particular standard. There's certain components of it. I'm sure we'll get into it. They submit that data to Fannie or Freddie, and then it gets accepted and you're good to go. You don't need an actual valuation component of it with like an appraisal. You just need the actual data. And then the fifth option is, let's say that the person, originally you get the value acceptance plus property data. Someone goes to the property, does that inspection, but then there's something wrong with the property. Each GSE has their own, specific component, or the eligibility of the loan changes. That's going to upgrade to what's called a hybrid appraisal, where essentially the data and inspection information that was gathered at the property is going to be sent to the appraiser, who then does an appraisal at their desktop with the data that was collected by someone else. So that's a hybrid appraisal. So now we have 5 potential options of what can happen for Fannie, which is the value acceptance plus property data, value acceptance plus property data turning into a hybrid, desktop appraisal, or a full appraisal.
Wow, it just got a lot more complicated potentially. But obviously they're doing this for some good reasons, right? I mean, we have known that there needed to be some change in the appraisal space for a while. Were you surprised at what they chose to do?
No, I think it makes a lot of sense. The reason why, I mean, you bring up a funny point, which is like, in an effort to simplify things, they are, slightly more complicated up front potentially. But essentially, there is just some larger macro industry level issues that weren't getting solved, which was this shortage of appraisers, where, there was no new appraisers coming into the industry, which, in times of high volume caused mismatch of supply and demand. And so, if you look at like 2020, 2021, turn times for appraisals were like 2 to 3 weeks. Like, they were a huge issue. Everyone was frustrated. And that was because, think of like Uber or Lyft. Like, if there's not enough drivers, the ride times are going to be too slow. So the question from the GSE standpoint, or the secondary market in general, and this is where I think appraisers get it wrong. The appraisal isn't just to get the perfect, value of the property. The appraisal is there to protect the lender or the owner of the mortgage in case of foreclosure, so that they can feel confident that if it unfortunately does go to foreclosure, they can recoup the value of the loan. So so basically the lender, the secondary market, they need to feel comfortable enough with the value, right? That's the point. And so if you think of the spectrum of transactions, if you have like a very cookie cutter Texas ranch with 20 other identical Texas ranches, you don't necessarily need to do a full-blown evaluation. You basically need to go confirm that the building is standing. There's not like, mice running around everywhere. It's a livable condition. And then, with that, you feel pretty comfortable with the general value based off of the characteristics of the property. So what these new products allow for is almost like a load balancing, where if, the volume does get too crazy, or on some percentage of transactions where the GSEs or secondary market feel like the risk is acceptable, we don't need that full-blown evaluation. We just need someone to go and confirm, the actual property data and make sure that the property is, in a decent enough condition. So I think that it helps solve for the longer term supply issue, because the people doing this data collection don't need to be licensed appraisers. So there can be new blood with lower barriers to entry to fulfill these products.
I can see how that's potentially a win for lenders, but I understand that appraisers might feel differently there, especially when it comes to that third-party data collection. That has been something that they've been alarmed at for a while. And what I heard, especially at like Valuation Expo, other places like that, where I heard lots of appraisers on panels, was that they didn't want to be liable for whatever that third party was doing. But in this case, it's actually the lenders who are liable, I believe. I mean, they skip right over the appraisal if it's going to be a true value acceptance, or what we call an appraisal waiver plus property data collection, correct?
Yes and no. So in the first example where it's just the value acceptance plus property data, and yeah, someone goes and does the data collection and that's it. Yes, you're correct. The lender is the one who has to, quality control that report, make sure that it aligns with the standards that they have to from Fannie or Freddie or whoever. However, if it upgrades to a hybrid appraisal, that's where the appraiser does have to validate and sign off on that data. So if it goes to a hybrid, the data collector sends that data to the appraiser, then the appraiser is doing an actual appraisal with that. So that's where there was some concern about the liability, where appraisers were saying, how can I trust this data, all this sort of stuff. And, they've changed and if you get really in the weeds of appraiser speak, people are concerned with USPAP, which are the Uniform Standards of Appraisal Practice, and, various language within the actual forms themselves. And so there's been changes to the forms to accommodate this stuff. And ultimately, it's on the appraiser. The appraiser does not have to accept this. So if they take a look at the data and they say, I am unwilling to pledge my appraiser's license on this, then they can simply reject it, and the lender will have to order a full appraisal. So it is at the discretion of the appraiser, but it's not like they're forced, to take these on, right? If there's any question about the data, then they can just reject it, and the lender will order a full appraisal. So yeah, it'll be an interesting, I think that there's always a loud minority of appraisers that vocalize their opinion, but so my platform, Reggora, we didn't do much of an intro, but we have like tens of thousands of appraisers on the platform. We did a survey around, which appraisers would be interested in participating in these products, and the vast majority of them want to. So they're just the ones not speaking up, right? So I think it'll be interesting to see, when these actually go full blown live in April, and see, put your money where your mouth is, which appraisers are actually taking the orders, which ones are rejecting them.
Really interesting. And interesting that you guys found that most of them are accepting of that. Have we figured out yet what professionally trained means when it comes to property data collection? Do we know, like, if the lender and if the appraiser are both like, we're going to trust this data, how do you then vet the people who are doing the property data collection? And isn't that just like, how does that save the lender anything if there's still a whole nother panel of people they have to employ to do that?
Yeah, so this is where you got into, it's good. How did the lender feel about it? How did the appraiser feel about it? And then, these AMCs or these other third party entities, right? So lenders today manage their appraisal process in one of two ways. I can either manage a panel of appraisers directly, or I can use AMCs, appraisal management companies, or some mix of in between. And we don't need to go down that rabbit hole in terms of, why some people pick something, one or the other, right? But to your point, for a lender who manages their own panel of appraisers, this will be extremely difficult, if not impossible, for them to fulfill these new products without relying on some third party. If I'm a lender, I would have to recruit an alternative workforce, come up with a training program, run background checks on them, manage them from a vendor standpoint, right? It's not an easy task. And so the, very, very likely, if not inevitable, direction will be that for these types of products, lenders will outsource them to third parties, like AMCs or other types of companies. So, and there's, a handful of providers that are already approved with the GSEs. We're actually going to be approved. And so the quality of the training is honestly going to be dependent on which provider that you're working with. So, and there's no uniform standard, unfortunately. There are some things that are hardcore requirements, like background checks and things like that. But you have some providers who are using real estate agents, some providers who are using insurance adjusters. But essentially, there'll be some training program where, they're going through and explaining how to do these inspections, how to use this particular app, what goes into it, all that sort of stuff. Hopefully they're doing some testing. I know we are, and have some sort of program to manage the quality of those people. And so the lenders won't be managing this directly, but they will have an oversight program with that third party. So the lenders are going to have to create policies where it's like, hey, we need to have some way to validate that you are doing background checks, that you are running through XYZ. And so that'll be like a, vendor policy type thing between the lender and these third parties who are going to be doing this stuff on behalf of the lender.
So if I'm a lender and I already use Reggora, if I'm already relying on you for some things and now this is added to, that seems like that would be easier than like I have an in-house panel and now I have to do this. It feels like that would be easier.
We think so. Yeah. So, that's
Right.
that's the goal. Yeah.
Fannie didn't really lay out a lot of standards for what that property collector has to look like, but what they did do with this is really standardize the information they're looking for in order to give a value acceptance. What are some of the things that are different now, around that standardization?
Yeah, the handful of things. So first of all, there's way more data points that would typically be associated with inspection. So if I'm an appraiser, I'm doing an inspection, that will be, probably less than, there's like hundreds of data points that are relevant for these new inspections. So you're filling out tons of different things. You're taking dozens and dozens of photos across the entire property. You also have to generate a floor plan that's in, for Fannie at least, ANSI standard, which has its own different characteristics in terms of how you measure gross living area and how you structure certain things. So, it's going to be way more standardized. And I think that is part of the whole point of it, right? They can take a much more data-oriented approach to evaluating these properties. And that's honestly what held back a lot of automated valuation models, AVMs. Like if you look at the history of the industry over the last 5-10 years, there was always the sky is falling from appraisers about AVMs. And in reality, AVMs, are only as good as the data that you feed them. I'm sure everyone has had this experience with Zillow or Redfin where it's wildly off. And that's because you need the actual granular detailed data to fill these things. So I think that was the goal of the GSEs, is to get way more detailed and standardized information for these inspections so they can do, greater insights with them on an aggregated basis.
It has always been amazing to me that the floor plan is one of the hardest things, or getting accurate square footage on a house is one of the hardest things to standardize.
Yeah, I think actually Freddie Mac had a funny stat that was like, even amongst appraisers, the gold standard of this stuff, when you send in multiple appraisers to the same property, the gross living area square footage can differ by like 20%, which is massive. So with these, new standards that are often completed by an actual phone or software platform, it should hopefully get much more uniform. And that's, helpful with the new advances in technology like LiDAR and the accessibility of that stuff within the phone. So it actually is, things that recently are getting unlocked that, weren't available 3, 4, or 5 years ago.
So who are you guys looking at to hire for this third party data collection? Like you mentioned some people, real estate agents seem to be a very, easy thing to think about. Also inspectors. But you might say, real estate realtors or real estate agents might have skin in the game, right? They might want things to be valued higher than that. How do you decide who should be in this third-party data collection?
That's a really good point, and I'm glad that you brought that up to clarify. So one of the requirements is that the individual who is doing the actual inspection must, just like an appraiser with appraisal independence laws today, they cannot have any vested interest in the transaction. So it's not like the listing agent or the buy side agent or anyone like that can be involved in us, or even like an agent whose brother, is the one selling the property. In order to take this on, they have to have zero connection to the actual transaction. So that can be, vetted in a variety of ways. But yeah, we're to your point, looking at real estate agent, real estate brokers who have experience in this stuff. I think they are a great candidate for this stuff because they have experience in the space. Interesting stat, like the bottom 50% of real estate agents are doing, only a handful of transactions per year. And so, it's usually a part-time gig sort of thing. They're looking for additional income and helps them build up, experience further in the space. So, but yes, there, definitely you want to make sure you're avoiding the conflict of interest, and there'll have to be various controls in place and kind of, retroactive auditing on that stuff as well.
It's a great point. I would think that if you are a real estate agent and you have a proficiency in this, it would just help your other business, right? Like when you're walking through a house, you're going to notice things in a different way. You're going to be able to educate your, customers in a different way, I would think, after you've looked at a house through the lens of that kind of property data collection.
For sure. And I forgot to answer your other part of the question, but I think it ties into this, which is like, how do we or some other third party decide which agent is going to be, the one to do it? At Reggora, we've built like various algorithms that look at, it's like the Uber metaphor. We look at the proximity, the driver score, how accurate they are, their quality. But to your point, you want to keep people in tight geographic areas because they build up, expertise in that particular area. So if I'm a real estate agent and I've done 30 of these inspections in particular neighborhoods, for sure, the next time someone's going to be looking to understand or work with an agent, you're going to be one of the best candidates for that because you know the ins and outs of all these properties.
That's really interesting. All of this is part of the appraisal modernization effort that the GSEs want to undertake. And as you said, like it wasn't even possible to do some of this, say 5-10 years ago. I mean, we just didn't have the kind of tools we have now or the kind of algorithms we have, the tech involved that helps get this done. From your perspective, what's next? And how does this fit into the appraisal modernization that they're trying to do?
That's a good question. The unfortunate nature of our industry is that it is extremely highly regulated and concentrated within a few parties. So even if there's the most amazing thing that gets announced tomorrow, we would have to wait X number of years for it to get adoption amongst, the GSEs, for example, or other. Well, this is a good point that we didn't talk about, but there are other secondary market investors who are not approving these products yet. And so unfortunately, the technology is kind of dependent on the adoption, but I think probably some 3D stuff, is kind of like the next, and that's already some aspect of it. But I think, there's not necessarily kind of groundbreaking tech from that standpoint. Like the LiDAR is good. It's extremely accurate in terms of getting the measurements. Some people talk about like drones and things like that, but, I'm not very bullish on stuff like that. I think it's more going to be about like workflows, like, how can we get a 3D rendering with the floor plan of this stuff up front in the transaction and not just, at the time of ordering and all that sort of stuff. No, I don't think there'll be necessarily like breakthrough hardware or anything like that in the appraisal world. I think it's going to be continued refinement of the workflows, continued adoption improvements, and, just kind of incrementally moving the needle forward.
Very interesting. If I'm a lender, it seems like we talked about the complexity. And to your point, like, how do I know at the front end? How do I have a workflow that says this is the best option at the front end and get better at that? Like, do you feel like this is pretty confusing for them? Or do you feel like, no, this is where, their tech partners, their AMCs come in and can really help? What do you think?
No, it is definitely more complex in the beginning for sure. And that's where we think it's helpful, to your point, around kind of having a unified partner, because let me just give you a couple examples. As I said, some of the secondary market investors don't accept this stuff. Sometimes Freddie will say yes and Fannie will say no, or Fannie will say yes and Freddie will say no. So, how do you know what product to order? Because obviously it's a very bad scenario if you order one of these products, but then you have to go back and reorder a full appraisal, a week later, costs everyone more money, takes more time. So you want to do everything possible to avoid that scenario. Some lenders do know which investor they're going to sell to by the time that you place the appraisal order. And so you can set up various automation within, the platforms to say, okay, if this field within the LOS system says this investor, we're going to order this type of product, right? And X, Y, Z. But some lenders don't know who the investor is going to be until, after the appraisal necessarily. And so that's where I think it'll be this interesting dynamic that we'll find out here in a couple of weeks, which is, are lenders going to want to maintain optionality and just stick with full appraisals, until it's more broadly accepted? Does this help some investors actually edge out others? If all things are the same from a pricing standpoint, but I don't need to get a full appraisal with this investor, but I do with the other, I'm like, is that going to make me lean, that way? So these are all the things that we're going to have to probably wait and see how they play out. But to your point, a lender has to kind of figure out what they're going to do now. And that was just the tip of the iceberg. It's like, how are you going to pay for this? What are you going to charge the borrower? Which parts of it are you going to pay or not? There's a lot that goes into all this.
Well, and another big part of the push from the federal government right now is to stamp out appraisal bias, right, in different valuations. So one of the questions I have is like, when you think about the process to get a new appraisal, right, is already not not necessarily very transparent for some of the parties involved. How does this make that easier? Or do you think that, the standardization that they're asking for in the data could make it easier either to stamp out appraisal bias or at least identify it? What are your thoughts on that?
Yeah, I don't think that it helps a ton in the first part that you mentioned of, because first of all, on like the value acceptance plus data collection, there isn't even any value, right? It's just getting the data. So where it becomes more relevant is on maybe like these hybrid appraisals or a retroactive look. Like let's say that a lender or Fannie or whoever are going to do a retroactive sample analysis of like looking at an appraiser's reports and things. Yeah, to your point, because there's much more detailed and granular data about the actual property itself, there will be less room for subjectivity. And so if there are kind of clear offenders that go against the grain in terms of, the facts, it's either incompetence or bias, right? And either of those are not good, and so so I think it'll help the most with kind of retroactive look backs versus maybe anything kind of on the spot.
Back to what you said about, how many lenders are actually going to do this or on what properties are they going to do this. One of the things we saw with desktop appraisals, you had a number of appraisers who were just like, I'm not using it. I'm not doing it. And there was just this lack of adoption, even though it was accepted. Do you feel like that's going to be the case here?
No. And there's a couple actual logistical workflow reasons why I think that was happening, because on the desktop appraisals, they still had a floor plan requirement. And so it kind of went against the whole purpose of it, where, an appraiser couldn't do a desktop appraisal unless they or someone else went to the property and actually got the floor plan. So it kind of defeated the purpose of it. With this, you don't actually need the appraiser at all, and so I think that we've put out material and offered like consulting sessions to help lenders, through this stuff. And we've seen way more demand and interest for utilizing that. And, pretty much everyone we've talked to has been like, yeah, we're going to be interested in using it. So I think that there'll be much more adoption on this compared to the desktop.
So Brian, I can see why lenders might be excited about this, but there are some different kinds of risks with using this program, right? And with these changes, can you walk us through what those might be?
Yeah, totally. So, the good part about the full appraisal when you're selling to the GSEs is that you have this feedback mechanism called UCDP, where, when you submit the appraisal to the GSEs, they give you feedback of what they think is wrong with it. They give you a score, and it helps guide the underwriting process for a lot of lenders out there, especially the ones who don't have, dedicated appraisal underwriting departments and maybe aren't as more sophisticated from a technology standpoint. And so the issue with these new products, not an issue, but just, a hurdle that needs to be overcome, is that there's not a similar API like that, at least yet, where once this data collection gets sent to the GSEs, they're not giving you, the lender, feedback on what they think is right or wrong. And so as a lender, you're still liable for the data integrity, because some things, if they're relevant on the property, can actually change things. So for example, if the condition of the property is absolutely horrible, the Fannie will reject that and, will not allow you to sell the loan. So if the data collector says, yeah, the condition's great, but then the photos say something else, the lender is going to be the one who needs to identify that and proactively fix it by either ordering a new product, requesting revision, X, Y, Z. So the problem is a lot of these lenders have never underwritten these products. They don't have checklists. Maybe they don't even have technology in place. And so that'll be something that these lenders will have to overcome, is what are they going to be using to underwrite these? How are they going to be doing it? What's the training going to look like and all that sort of stuff. So we've helped bridge that gap a little bit. We've made like a template checklist, that folks can use, but I think there'll definitely be a little bit of a learning curve for folks.
So technology does have a part to play in that though, right?
Yes, for sure. Another key difference, and this is like for the really in the weeds, people of mortgage ops, like when you submit an appraisal, there comes with it XML data, which allows folks to extract the individual data points and actually run rules on it. So it's not like if you get an appraisal, you just have to manually look at it, right? With these new reports, there's no XML, but the data comes in like JSON format. So hopefully your technology provider can or is working on something that can extract the data from these reports and similarly run rules on them. So that, should be available for at least the kind of forward-looking technology providers and things like that. And then the next frontier is probably stuff around photo recognition AI, where instead of a human underwriter having to say, hey, the data collector said that this condition was a C5 score, I look at the photos and I say, yeah, I agree with that, or no, I don't. You have an AI that's trained on thousands of photos that says, hey, based off of, this, no, I think that fails, and it's actually a C4 rating or C6, that sort of thing. And so that's probably the next frontier to continue to help automate the underwriting process for folks on the appraisal side.
That is fascinating. There are so many parts of this. When we reported on it, we were like, basically, we felt like Fannie was saying that the appraisal is no longer the default option, right? It's not like you have to apply for an appraisal waiver. It's like, it's kind of like, yeah, sort of the doors are thrown wide open at this point.
It's so funny. So we're like a venture capital backed company. A lot of my investors aren't necessarily directly in the appraisal industry or from the mortgage industry. So when that headline came out and that exact language that you said, appraisals no longer the default, people are like, oh my God, are you guys going to be okay? What's, because we're in the appraisal business, we're in the valuation business. And I had to send a bunch of emails. It's like, no, this is good for us. We've been planning this, we've been actually working with the GSEs on this stuff. So yeah, it's, and same thing for the appraisers who are like, oh my God, we're, our days are numbered. No, that's not the case. These are going to be a small percentage of transactions to start. They'll ramp up over time, but there's a lot of complex things going on that still require a lot of, hand-holding.
And I think that's been the story for appraisals, for valuations for a while now, is it's like, yes, we have the technology to do some of the very cookie cutter things, but to your point, there are plenty of properties that don't fit, aren't going to be ones that you can do this on anyway.
Exactly. Yeah. We expect this to be a narrow percentage of eligible properties that will, probably grow over time, but, will never be a majority of transactions necessarily. And even if you look at during 2020, 2021, appraisal waivers got absolutely crazy and peaked at 40, 50%. They're down to 15% in kind of normal times. So, we expect these alternative products to be, in similar types of percentages.
Well, Brian, it has been a fascinating conversation. Thanks for bringing your knowledge and letting us know about all these changes, and especially the ways that it's going to affect lenders and AMCs and appraisers. Thank you so much.
Yeah, thanks for having me. It's great here.